What the image you're looking at shows is a 1-hour trend in Euro New Zealand dollar Forex pair. My 1-hour Forex trend trading resembles my 5 minutes SPX 500 trend trading. I take entries at the historically confirmed bouncing levels along the trend. When I first saw this chart, I realized that it will present high probability historically confirmed bounce off the EMA 50 at the level marked by the line labeled first enter. At point C, I expected a historically confirmed bounce off EMA 50. Historically confirmed because the price has already bounced off EMA 50 twice along this trend in point A and point B. At the point C, I entered my short expecting another bounce in the direction of my trade. My entry point is marked by the line labeled first enter. As it happens from time to time, the price action did not what I expected it to do and moved above my entry point as my trade went into a loss. When my trade went into a loss equal to about half of my 1% loss allowed per trade, I refused to take this loss and hedged the position at the level marked by the line labeled active hedge 1. Hedging at that level means that I entered a position size equal to the size of my first enter but in the opposite direction, meaning that since my first enter was short, my hedge position was long. What this maneuver did was freezing the loss I so far incurred. This means that from now on, as long as the hedge stays in place, no matter what the price action did, my incurred loss would remain the same. Please note, and this is the most important point here, when I placed my active hedge when I did not take the loss, I just froze it at about 0.5% of my account. The money lost was not really lost. It was not subtracted from my account. My hedged loss started waiting for another bounce opportunity where I could start working towards undoing it and possibly end this trade with profit rather than loss. When the price reached the level of the thick horizontal black line, I expected high probability bounce off that level. Hence, I entered my second short at the level marked by the line labeled second enter. Same size as the size of my first enter and the size of the hedge. I also placed waiting second hedge order above that line in case the expected bounce would not happen. The price would go higher, and I would have to place another hedge. As it turned out, there was no need for the second hedge since the price started moving in my direction. When I saw that the expected bounce is happening, I placed my second short at the level marked by the line labeled second enter. As the price started going in my desired direction, I added 4 more shorts, each of the same size as all other entries, to overcome the frozen loss and to end up in some profit as soon as possible. As soon as the price moved to the level at which my frozen loss was overcome with a bit of profit, I closed all positions. In this way, the trade, which would end up with 0.5% loss, not only recovered but also went into profit. And this is the miracle of hedging.